Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne with Annabelle Droulers.
Our top story is cautious trading in Asia despite gains on Wall Street driven by U.S. inflation data showing little impact from President Trump's tariff barrage.
NVIDIA extending its rally on a White House plan to dump Biden-era chip curves that wrangled allies while keeping restrictions that target China.
Also on the program, Wall Street banks raised their forecast for China's economic growth this year, citing the trade truce with the U.S.
Plus, China tech earnings in focus as JD.com surprises investors with its biggest jump in sales in years. Next on deck is Tencent, China's most valuable company.
All right, taking a look at the market action this Wednesday morning and U.S. stocks. I mean, it's pretty exceptional. We have erased the losses on Wall Street this year. What trade war is maybe what some investors are asking this morning. In Asia, look, it's a little bit more muted. You can see there broadly we've got the MSCI Asia Pacific Index sitting flat this morning. So investors are sort of a bit in wait and see mode. But take a look at Taiwan just coming online, 1.4% to the upside. Certainly reflects what we saw overnight, which was the chip makers leading the rally. Across assets as well, one to note, because we're just watching yields pretty closely this morning. We had that U.S. inflation data coming through overnight. The print cooler than expected. So it does seem that companies, they're not really passing on the cost of tariff to consumers just yet. TSMC there you can see 2% in the green. Let's change on. That's really sort of the upsides for the markets this morning. Of course, there's always some sort of downside to it as well, and you see that reflected Golden Dragon Index yesterday in the session as well. Investors are really thinking now, do we even need so much stimulus in China? And so that is being reflected. Earnings to note as well, because Golden Dragon Index, U.S. listing, JD, of course, we had those numbers, gains there of more than 3%. But essentially, fastest pace of revenue growth we've seen for the company in a couple of years now. I think going back 3 years, actually. Going to get more details later on that competition we see between JD and Meituan in the food delivery space. Futures ahead, look, it's fairly muted again for the Chinese session. But as you said, Yvonne, it's also that focus on earnings. We've got JD, but coming up, we've got Tencent, for instance, Alibaba as well to end the week.
Yeah, we're certainly going to be looking at these earnings calls, what the CEOs are going to say about tariff, the impact, and how this is really going to play out. And then, is it going to continue to spark in this HS Tech rally that we've been seeing of late as well? We do have some breaking news to bring to you when it comes to Peru. Now, we are learning that the Prime Minister, Gustavo Adrianzin, has resigned ahead of this censure vote. So this is what we have been hearing from earlier local reports, that they were organizing this transfer of power, and they are deciding between two names, according to some local media. But lawmakers did file that proposal to fire Adrianzin last week, following, of course, those violent incidents in the mining area. So that is the latest, and we're hearing from the Prime Minister of Peru. We'll get to that a little bit later once we get more information. Let's talk a little bit more about the markets and why we're seeing this rally underway, right? U.S. inflation, basically, we did see soften for a third straight month. That certainly is helping when it comes to what the Fed could do. Maybe that gives them a little bit more leeway and maybe pushing back now those expectations of when we could actually see those rate cuts. I believe Barclays was the one that's saying only just one Fed cut this year, maybe pushed back to December, they say.
Yeah, certainly it does seem that that Fed path has been pushed along, and really there's a lot of uncertainty. Of course, this trade truce, it's only for 90 days, and we don't really know what's going to happen between now and then. But two things really at play. You've got those companies that aren't passing on the cost to consumers. Yep. At the same time, you're really seeing consumers start to pull back, and we saw that softer services side. So people aren't really going out so much to spend on things like leisure and travel as well. So US inflation there, you can see in the chart, slowing, lowest we've seen now going back 4 years. And we're going to get more on this, of course, just in a few minutes from now. AIA Group is going to be joining us up ahead, talking about market strategy, trade ties, of course, between Washington and Beijing. The reset, perhaps. But President Trump, he has been in the Middle East as well, speaking with the Saudi Crown Prince, Mohammed bin Salman, announcing a pledge for what the president says is $1 trillion in commercial deals. Now, there is some doubt maybe around that figure, but it does include almost $142 billion worth of weapons sales.
We have the best military equipment in the world by far. That is undisputed. Our fighter jets, our missiles, our systems, our Patriots, everything. We have the best equipment. And Beyond that, you're purchasing pledge, you're purchasing a lot of different things, and I appreciate it. And you said, if you think 600 billion, but the 600 billion knowing you will be $1 trillion.
Today, we are working on partnership opportunities with $600 billion, including agreements worth more than $300 billion that were announced in this forum. In the coming months, we will work on second phase to finalize the remaining agreements to raise them to $1 trillion.
Yep, and President Trump's visit to the Middle East has opened a floodgate of AI deals with the likes of NVIDIA and AMD planning to spend billions of dollars in the region. Let's bring in our Bloomberg executive editor for global technology, Peter Elstrom, joining us now with the details. Peter, it's great to have you here back in the region. How big of a deal is this?
This is a very big deal. I mean, at a high level, it's a sea change, really, in U.S. policy towards some of these countries and their access to American technologies, including AI. The Biden administration had implemented a series of curbs on what foreign countries could buy, especially AI chips. The most advanced ones are made by NVIDIA, of course. And the Biden administration had a very complex approach, a framework that they passed the last week in office, where under this rule called the AI diffusion rule, there are 3 tiers of different countries. You get different access to different levels of chips under that framework. The Trump administration has now just thrown that out. And instead, they repealed that formally just this week. And instead, they're going to do these bilateral agreements. What we saw during this trip is that they're striking deals now with Saudi Arabia. They're also going to do this in UAE. We've been able to break some news around that. But the result is that some of these countries that have decided to more closely align with the United States are going to get much greater access to chips because of this. In the case of the UAE, for example, it's probably 4 times as many chips as they would have been able to get otherwise. So it's significant, of course, for the allies, but it's also a big deal for companies like NVIDIA, which are going to be able to sell a lot more than they could have otherwise.
Yeah, and that, of course, was the big concern and the big pushback that we'd seen from Silicon Valley. The concern, though, of course, is when you have these sort of what would have been the tier 2 countries or regions that are getting more access to chips, the technology still has a way to get to China, and that is, of course, what it's all about. So how are they going to be preventing that from happening, or is it even possible to prevent it?
Right. Well, it's a very important point. There have been concerns, especially with the UAE and some of their companies, about whether these chips could somehow leak to China, either directly the physical chips, or they could tap into these computing capabilities through cloud computing in particular. They haven't disclosed any of those details at this point. We don't know what those are. At a high level, they're striking these deals where there'll be more access to these chips, but they haven't worked out some of those nitty-gritty details about how they're going to block China from getting access. That has been raised in Washington, even by some of the Republicans who are Trump allies, allegedly, raising questions about whether China is going to get access to these.
All right, Peter, thanks very much for joining us. And, of course, you can have lots of reasons to be coming back to the region as well. But that was Peter Elstrom there, Bloomberg's executive editor for global technology. Counting down to the open of trade, of course, mainland China, Hong Kong in just about 20 minutes from now. Earnings, the big focus this morning, JD.com. Of course, we saw it rising on Wall Street overnight. It is indicated to pop around 5% at the open in just a few minutes from now. Best pace of revenue growth we've seen going back 3 years. This is The China Show.
I think in retrospect, perhaps holding cash would have been the best way to navigate this, but that's so contrary to our culture of always trying to be on the offense, always trying to find ways to create value in the markets.
Citadel founder Ken Griffin there commenting on the recent market volatility due to the trade war between the U.S. and China, talking about cash might have been the best play during this whole tariff volatility and like. Let's bring in Mark Konyn, AIA Group CIO, who was also overweight cash during these turbulent times. I got to wonder, though, you've been kind of neutral to equities, yes, on credit, duration, I should say, underweight credit.
Underweight credit significantly, yes.
That was during Liberation Day. How are things changed now that we have seen at least tensions?
Yes, at least on the surface, it seems as though there's a pause in the market. Volatility's come back down. VIX is below 20, having spiked above 50. We were just talking about that. So now it's an opportunity to take another look at the portfolio. I think last time we chatted, we talked about what do you do in a period of heightened volatility. Don't take any extreme bets. Make sure your book is pretty balanced. So equity weightings across sector, across markets, nothing extreme. I think now with the market moving up in the US, our overall view is the US economy will slow this year, continue to slow. not necessarily a recession, but will slow. And therefore, we're reweighting, taking the opportunity to reweight further outside the US, taking opportunities in other markets, but also generally slightly underweight equities.
So what are the opportunities then that you're seeing in the other markets?
Well, believe it or not, the A-share market, we see some value there. In Europe, though, a lot has already been priced in. Emerging markets have done well. Underweight credit in favour of govies, cash. So basically keeping the risk broadly neutral, but slightly underweight equities. From a macro point of view, our models are telling us something very different. They're telling us to sell equities significantly. But the earnings season looks like it's holding up reasonably well.
You also have a call about we might actually see wider credit spreads.
Yeah, nothing dramatic.
Okay.
We're not expecting a blowout, but we've been working off very, very tight spreads. So naturally, in a cyclical environment, you're going to see those spreads move out a little bit. We've seen a steepening of the curve, normalisation of the curve, you might say. So generally underweight credits, and we still have building up positions in privates, particularly private credit.
We're just getting President Trump actually speaking in a Fox News interview saying that they've got the essentially the framework now for a very strong deal with China. At the same time, there's other people that are saying this is something that could take 2 to 3 years to hash out. So what happens over the next 90 days? And also, what do you think beyond that if we don't get something that's really clear-cut in this sort of time?
Yeah, very difficult to see us get anything really clear-cut. The headlines are great, though. We saw China's resumed taking delivery of Boeing planes. These are great headlines, boosting share prices, improving sentiment, reduction in tariffs. There's a lot of work to be done. I don't think 90 days is going to be anywhere near sufficient to hammer out an extensive deal. And remember, in 1.0, Trump 1.0, that trade deal was never fully implemented. So there's a revisit of that as well coming. So I think markets are relieved, but I don't think overplaying it. A lot of the good news already priced in, and you can see that sort of reflecting across markets in Asia today.
Yeah, and despite things kind of looking better in equities, the dollar continues to head lower. We had a bit of a short squeeze, I guess, last few days. But what does that tell you about this whole de-dollarization? Is this a paradigm shift? Well,
it depends on your time frame. If you go out long enough, it's going to be a paradigm shift. But we don't see anything near term. I think the stability of the U.S. financial system, the importance in a global context, that's not going to change overnight. But yes, the dollar will continue to trade lower. It's on a sort of downward trend, and that's going to continue. We've seen the re-emergence of dollar issue in emerging markets, in bonds, for example. But dollar was slightly weaker, and currencies in this region benefiting from that.
Of course, the Taiwan dollar really shocked everyone. I mean, it was Yvonne's first day back from maternity leave, and she came right back.
Two hammering days.
Came right back into that one. But hedging strategies, I mean, given what you're saying about that dollar and the downturn, does it make you rethink anything?
Well, for us, we hedge extensively in the book. So, our rates exposure is extensively hedged. In terms of operational cash, we typically hedge part of it, if not much of it, to make sure that our reporting currency is protected. But overall, if you look at what's going on in the market, not easy to hedge NT dollars, so a lot of proxy hedging going on, and you saw that in the yuan, for example. So I think that will continue. There was concern domestically in Taiwan, where a lot of the positions that the lifers took were unhedged in US dollar securities, in particularly treasuries and fixed income bonds, and some of that was starting to play back. So probably we're going to see a continuation of the strengthening in the NT dollar.
Okay. And is this something that you think will go beyond just Taiwan? I mean, what do you make of these kind of dislocations that we're seeing across
so
the region?
Yvonne, it could develop into a major dislocation depending on how far it goes. We've been there before, so it's something definitely you watch. I mean, during that period of heightened volatility, we're in 18 markets across the region. We're running money from 12 different locations. We got in a huddle and make sure that compared our assets to our liabilities with the significant move in rates and FX, that we were basically in line. And a lot depends on your systems, your data provision. So a lot of the work we've done in the last 3 or 4 years has paid off.
Yeah.
We've just got the yuan reference rate out. You can see there at the bottom of the screen. But I want to ask about the dollar trend and vis-a-vis the direction of the Fed.
Yes.
What are you seeing this year?
Yeah, we're still seeing 2 cuts this year, June or July being the first. June would be opportune, given that they sort of reforecast their economic outlook. So it would be a good time to announce the first rate cut. What we're seeing is as the long end backs up, it's an opportunity for us to put on a little bit more duration tactically in expectation that will come down thereafter. So that's a trade that we like. Don't need to take a lot of risk. It's paid off in this period of increased volatility, and it's probably a trade will continue.
Most people think that, given the inflation print that we saw in the U.S., that the Fed's not in a rush to cut because the tariff impact seems to be at least not as big of a concern anymore.
Hasn't passed through yet.
Yeah.
Businesses have been reluctant to pass on the effect. There was a bit of front loading in terms of imports. That will still come through. Tariffs are still there, so it is inflationary. But if we compare it back to 21, 23, you don't have all the bottlenecks. You don't have the US ports with a problem. You don't have an imbalance in demand and supply of labour. Now you have more supply than demand in the US, and energy prices are lower.
Yeah.
So we don't see that push through in terms of inflation expectations. Probably hasn't peaked yet. We're expecting a peak US inflation about 4%, coming down to about 3% towards the year end. And given that, and given a rate cut and the fiscal announcement probably coming through in October, we're expecting US GDP to level out at about 1.3% for this year by year end, which is below trend but not a disaster.
I'm just taking a look at your notes, and you've got a contrarian view around US bond yields as well. So
Yes.
talk us through that one.
Yeah, that's, as I was saying, as you see the long end move towards 5%, there's fears that inflation will sort of get ahead of itself and that will continue to break through. We don't think that's the case. We think inflation is anchored, lower energy prices, more of a balance in terms of supply and demand of labour, and therefore peaking and then coming off, and therefore there is an opportunity, a contrarian view, to go slightly long of duration as we go through to the rest of the year.
You mentioned that the opportunities are in China now, A-shares.
Yes.
What's sentiment like now? I mean, are people asking you more questions about how to invest in China?
Well, remember, we're onshore in China, so we're domestic, so we have to invest domestically. So it makes a lot of sense to hunt out opportunities where you're getting higher yield. We're seeing a lot of work done on cleaning up the supply chains and making sure they're robust given the trade tensions. And earnings outlook is reasonable. So in that environment, we see opportunities. Tech sector in particular.
Yeah, I was going to ask about the tech sector. Do you think that still the DeepSeek effect is playing out? It was kind of interesting because there was so much anticipation that we'd see those better growth forecasts or earnings forecasts, but it didn't really translate that much.
It's a slow burn. As we saw in the recent announcement to try and support the economy, we saw the cut in reverse repo rates, we saw the cut in the prime lending rate, and we saw some measures coming in to boost support for spending, whether it was elderly care or the tech sector directly or agriculture. These are all sort of incremental steps that will support the economy, and it will flow through to different sectors.
Still, though, I guess those changing expectations, how much do we really need to see stimulus? And that's really being hitting
Well, they're going to be
sentiment.
disappointed because I think what we're going to see now is with this 90-day pause, I don't think there's any hurry to take any measures. Let's see how that plays out before we see another round of stimulus.
All right, Mark, thanks so much for joining us this morning. That was Mark Konyn there, AIA Group CIO. And again, that stimulus question is something that really played into sentiment yesterday. And we're seeing it again reflected ahead of the open. 10 minutes away from now, we are watching the China show, and this is Bloomberg.
All right, we're getting some lines now from Beijing, where the Brazil president, Lula da Silva, is speaking at a news conference and really saying basically that they're leaving Beijing quite happy. Obviously, we've been hearing of over 30 trade deals or agreements for Chinese investment in Brazil were signed during this trip between President Xi and Lula. So including the likes of mining, transport infrastructure, ports, as well as cooperation in AI and climate action. And they talked a little bit more about the defense of multilateralism, that they are in a united front on that part.
Yeah, and I think it's really that question as well. If you get that breakdown in the relationship between the US and China, China also needs to look to new partners. And the global south, of course, is one of the key ones that can kind of fill that gap. And that detente, though, that we're seeing between Washington and Beijing is also playing into the economic outlook as well, because there's some very interesting calls that we've had overnight in terms of banks lifting their growth forecast for China.
It's interesting. He mentioned here, Brazil will put reciprocity in its relationship with the U.S. Brazil is not afraid of competing with the U.S. There was a lot of talk leading up to this summit that Brazil had to choose between the U.S. and China, and we're clearly seeing where they're leaning towards now after this trip.
Yeah, absolutely. And just on those calls, JP Morgan, Goldman Sachs, so let's just get into them. So JP Morgan actually has upgraded its China 2025 growth forecast to 4.8%.
Yeah.
Previously been at 4.1%, and that is after these trade talks with the U.S. were actually a lot more constructive than they had expected. So growth for the third quarter, or second quarter to the fourth quarter rather, seen at 3% year on year. But again, it's that question around stimulus, and they're saying, you know what, we just do not need it right now.
And the assumption is that the tariff levels have to remain in place after this 90-day reprieve, right? So that certainly is one assumption that we have to think of. But yes, there you go. By the way, we have UBS coming on at the bottom of this hour, 4%. They're still holding on to that forecast. We'll talk to Yvonne about that in just a bit. In terms of the pre-market and what we're looking at in Hong Kong here today, we talk about what the tech sector is going to do. We're focusing very closely on JD.com. There you go, though. We're up about 0.9% on HS Tech is up 1.5%. That is thanks to JD.com. We are actually seeing a pop in those stocks about 4% after, as Bell mentioned, the fastest sales growth we've seen since 2022. We're also focusing on more earnings coming through from JD Logistics. Tencent is up. I think we have Alibaba coming up as well. So certainly there's a lot of focus on the tech sector this week, Bell.
Yeah, I think Tencent and Alibaba in particular, those numbers are going to be really key to understand whether the optimism that we've seen around China's tech sector, whether it can essentially be sustained. And as I was saying before, we sort of had the DeepSeek effect. We didn't see it translate so much into growth expectations or earnings expectations for these companies. But remember, of course, Tencent and Alibaba are also very domestically exposed. They're making a lot of money out of the Chinese consumer. Other names to watch as well, you've got SMIC and Haojun as well. So these are two in the semi space. They're actually doing a little bit better than expected. We did see semi stocks rising overnight, but this is actually something that doesn't benefit these Chinese players, because you've got perhaps more exports really from Nvidia, AMD, other US names going to the Middle East now. You've got the US that's repealing these Biden-era rules and making it easier to export US technology. Chinese semi-names had been the beneficiaries, though, because there was an expectation if the US pulls back, China needs to step up, and you're going to see more investment into these names. But anyway, pretty flat today.
It's lifting all boats, at least for now, in terms of what we're seeing in the chip sector there. But yes, a lot in focus here today. We'll talk a little more about the earnings with BI coming up and really what led to that surge in profit, or at least in the sales when it comes to JD.com. A lot to do with the competition when it comes to the food delivery space, as well, as Bell mentioned. You're watching the China Show. The Open is next.
Welcome back. You're watching the China Show this morning, counting down to the open of markets, and sentiment is looking a little bit better, actually. We had seen futures indicating perhaps we'd see a little bit of weakness. We've lifted off that so far. Some of the reasons for optimism, of course, you've had some upgrades to economists' forecasts for GDP. So this trade truce, that sort of detente, at least for 90 days. But at the same time, you've got those question marks. OK, how much stimulus is going to be necessary right now?
Yeah, perhaps they don't have to roll out too much fiscal stimulus, at least now that things have at least toned down when it comes to the trade tensions. And certainly that is one to watch. And I think the focus now moves more towards earnings, as we talked about as well. Now that tariff noise seems to have dissipated a little bit, we're going to look more into the economic fundamentals, or at least the fundamentals of these corporates. And JD.com certainly is one of the ones that we're going to be highlighting this morning here. But here's your open right now. We're pretty flat when it comes to your onshore benchmarks here this morning on the CSI 300. We're just hovering around that 3,900 level. In terms of what we're watching out for as well, it's really what comes down to the currency, which has shown some strength of late. But we're watching very closely that fix today was also quite strong from the PBOC. CATL is having a down day. There's been a lot of news about that upcoming IPO next week, and certainly that's one to watch. But it is overall quite slow. But you are watching commodities like iron ore, Shanghai crude catching a bid here this morning. Steel also doing quite well. Copper on the back of that, right? So So all these trade deals have been talked about between the U.S. and China, China and Brazil, for example, as well. That certainly is helping the commodity complex and helping with the whole sentiment here this morning. You flip the boards and watch what's going on in Hong Kong. We talk about that tech sector. Really, that's going to be the focus here today when you have the likes of Tencent Music, you have the likes of JD.com, all showing pretty good numbers for the first quarter. Revenue did beat estimates for both of those companies. We're watching Samsung. That's one thing to watch, though. Those shares are actually plunging this morning after the first quarter result did miss. There's still a lot of pressure around that company as well. But there you go. Tencent is up next. We're up some 1% there. Alibaba up 1.5%. So the tech sector doing quite healthily well this morning. As we talked about dollar China, we're still hovering on that 719 level as well. And yeah, it seems like property is probably the one sector that is slightly to the downside here today. So earnings. We talk about JD.com. Core business seemed to be good. I think a lot of questions was with the food delivery and how much they're really burning in terms of cash and throwing out those discounts to really continue in this whole battle. When it comes to the food delivery side of things. Interesting enough, there was a meeting between the regulator and some of these food delivery platforms too, Belle.
Yeah, absolutely. And I think exactly it goes to your point. You sort of have this competition to the bottom or the race to the bottom in lots of different sectors in China, but food delivery is one of them. And JD.com, it's a very ambitious play that they're making to compete against Meituan in this space. Chip stocks as well to note, because we're tracking names like SMIC, Huawei. We actually had seen those looking a little bit better in pre-market. Again, you're seeing that translating in the session today. But this is actually a bit of a different story. Still linked, of course, to the broader theme of tech, but we did actually see chip stocks and chip names like Nvidia, AMD leading the gains on Wall Street because we're seeing the Trump team thinking very differently around how these chip restrictions play out.
Yeah, it's a whole different approach the U.S. is doing when it comes to how they deal with these sort of chip curbs and really taking out some of the Biden era restrictions there. And certainly that does lift the boats of Nvidia and the like. We talk about the amount of floodgates and deals and chips that could be heading to that region now. Let's turn it back to China and really talk more about what this means. I'm bringing up Bloomberg Intelligence equity and strategy analyst Marvin Chen. Also joining us is UBS Global Wealth Management Regional CIO and head of APAC Macroeconomics, Yvonne Hu. Marvin, I'll start with you. Tariff reductions across the board, and really it has lifted a lot of boats. But what does it mean for China?
Yeah, I mean, we've seen the initial reaction quite positive because, markets see the tariff reductions as larger than expected. But we think this is kind of like, well-managed expectations, right? Trump floated 80% right before the talks. He floated 60% during his campaign. So now markets are cheering 30%. But, we think 30% is still quite disruptive for Chinese exports and is still one of the highest in the world in terms of U.S. tariffs. So what the tariff reductions does bring is some temporary relief for investors from the daily back and forth on the tariff rates. But investors will now have to start thinking about what happens after 90 days. There's still some uncertainty around a deal if and when that gets done. And in the end, it's all relative, right? What rates, what deals does the U.S. strike with other markets impacts China as well?
We had President Trump on Fox News earlier this hour talking about having the confines of a very strong deal with China. But what exactly could that look like?
Yeah, so if we look at, the key items from the first trade deal, I think, it could give us an idea how negotiations will go this time around, given that many of the key measures were not met. So number one will be China importing a lot more U.S. goods. In the first trade deal, this was $200 billion U.S. over 2 years. So this translates roughly to doubling China's annual imports from the U.S. Second would be market access in some of the more strategic and perhaps protected sectors in China. Along with that comes IP rights discussions. And lastly will be likely around currency management, how China manages its currency. So we think that, given that, a lot of the framework is in place, a trade deal could come quicker than last time around.
Earnings, that certainly is a big thing. What are you looking out for this time, particularly when it comes to the tech sector, too?
Yeah, so, we did see earnings revisions accelerate during April, likely due to tariffs. But really, this has so far just been offsetting some of the tech optimism from earlier in the year. So far, earnings outlook for China is down by roughly 2% from the start of the year. And this is broadly in line with the rest of the emerging markets. So, it'll be interesting to see if this tariff reduction, we see some stabilization in the earnings outlook after this announcement.
All right, that was our Bloomberg Intelligence equity and strategy analyst, Marvin Chen, joining us. Thanks very much for your time. And Yvonne, turning to you now, I mean, we just heard there around this sort of shape that the trade deal could take and the question mark, of course, of what it means for China's stimulus. But what's standing out to you right now for how Beijing responds and thinks about those discussions with Washington?
I think first it's like a positive surprise, to lower down to the 30% of the tariffs, although it's just for 90 days. So I think for the Beijing side, I think the first will continue to negotiate and try to keep at least not higher than this 30%. And also I think they have the chance to for the U.S. also to cancel, maybe lower the 20% of the fentanyl tariffs. I think then that would be quite positive for the market. And the second, I just as mentioned, for the stimulus side, in our view, I think for the monetary side, we'll still keep easy. So I think besides the rate cuts, we still expect 1 to 2 rate cuts and also 20 to 30% of the interest rate cuts for the second half. And also some support for the capital market and also for the re-lending. But for the fiscal side, I think its pace and the size, it's really will adjust against the progress of the negotiation. So I think that for that part, so currently with quite good data for the first quarter GDP data and also with the progress, we think probably the pace of the stimulus will slow down. I think the plan is there, including supporting for the consumption, for the elderly, for the infant, and then maybe some of the real estate projects. But I guess the pace will adjust.
Now it's the race to import stuff, right? I mean, in these 90 days, how much front loading could we see and what's going to happen afterwards?
I think the front loading, we will say, for this, for the second quarter, not only for China, for the whole Asia, I think the exports will surge, for the front loading. And then I guess, depends on, the negotiation. So I guess, among Asia countries, probably, for Japan, Korea, maybe India will come out the final results first. So that could set up some, a standard for the rest of the countries. So I guess, for China side, we think that there's a possibility to keep this the rate as 30% or even lower. The reason is I think that China still have the cards on hand, the purchase agreement, just Marvin mentioned, we still have the purchase of agriculture goods, LNG and other goods, and we have the fentanyl control, that's discussion at hand, and also for the issues for the illegal immigrants, return illegal immigrants. We also have the rare earths export control, and we still have the lots of control on that. And also I think the China for the U.S. side, of course, have the tech and AI. I think that the cards on hand. So I think that there is still room for negotiation because currently we have that regular communication system. So I think that this mechanism can ensure at least a relatively smooth market for the 90 days. But of course, uncertainty is there. But we think the chance of to reach some maybe at least keep the status quo is very likely.
You know, China is still pursuing negotiations and agreements with other countries as well. And just this hour, for instance, we've been hearing from Brazil's Lula, for instance. I mean, he's saying that the US should have talked to China before taking unilateral steps. But essentially that they've agreed that China will boost its presence in Brazil. So how much can China offset the risk from Trump? And how much of this is sort of permanent, I guess, rerouting that we see into new markets?
Yeah, I think that's also another strategy, another leg of the strategy. So we see China stressing its trade with ASEAN countries, with Latin American countries, and with the European countries, and also stressing for the investment, mutual agreements. So in our view, for the trade side, it's more in the future will be a preferential regional arrangements rather than this kind of global arrangements. And also for China, another side is pushing for the CNY globalization. So that's also very important. I think that yesterday China just signed the agreement with Brazil for the currency swap, and also the China is now is pushing for the digital CNY the system.
It brings a lot of questions about where the dollar moves from here. It seems like Trump's trade policies have really hastened this sort of structural change in Asian markets. You look at equities, you look at bonds, you look at currencies. Do you think that Trump is kicking off a process that has no return?
I think the returns for him, depends on how he count the return. He will always claim he's successful. So I guess for the purchase agreement, we can tell especially for the agricultural goods, LNG, and for maybe the defense items and autos. I guess that could be his gain. And also for some of the investment, for example, for Japan will already agree to invest more, and I think the TSMC and also set plants in the U.S. So I think that for the investment and the trade could be in the short term his gains. But of course for the longer term, I think his aim is for the supply chain, especially for the manufacturing move back to the U.S. For that part, we are not sure if he can succeed.
We've got earnings coming up later today from Tencent. We've also got Alibaba that's ending the week, and we're going to be watching very closely, particularly in Alibaba, what they say about AI, and this all relates back to the DeepSeek effect. And I'm curious for your view on whether you think that DeepSeek effect is still playing out in China, because it wasn't just something that really related to the tech sector. People were saying about the DeepSeek effect coming across all other sectors as well. Yesterday, for instance, I was on the phone, but I was talking with a pharmaceutical company in China, and they were saying how it had impacted their industry. So do you still see the ramifications or the ricochets going out?
Yeah, I think I would view DeepSeek is not only one company, not only for the software application. I think it's an ecosystem. So DeepSeek is built up the AI infrastructure for China, and can apply it to many other sectors pharmaceutical, manufacturing, and that's quite different from the U.S. I think for example, for the U.S. system is Nvidia ask every country have to build up its own data center, have to train its own AI. But in China, I think the system is more like an AI infrastructure, and then different sectors maybe can enter or kick in by the hardware. So China is a combine of the software plus hardware ecosystem. And also plus, I think that for the China side, for the application of the AI, and it's the strength of China.
I was speaking to Amy Lo yesterday at the New Voices event, and she meant, there are clients that are more interested now in diversifying away from the dollar and dollar-denominated assets. And she mentioned China as maybe the next destination. Where is the opportunities, I guess, do you see in China specifically now?
We recently just upgraded China's tech to attractive. So we also say for the AI ecosystem and also its related sectors definitely will be the future for China as well. So now currently I think there are several reasons for investors in China, the AI and also its application, stable CNY, or even could have the chance of the appreciation. Our forecast for the end of the year is 70.2, next year 70.1. And also I think that for China side, because its valuation still it's low comparing with the U.S. side. And also it's the market is less relevant to the U.S. So I think not only for the sector itself and also for asset allocation perspective, I think that China now getting attractive to the investors.
Yvonne, that was Yvonne Hu, their Regional Chief Investment Officer and Head of APAC Macroeconomics at UBS Global Wealth Management. And actually just coming back and recapping some of those lines from President Trump's interview with Fox News. It has just ended, but pretty wide-ranging and coming, of course, as we know, President Trump is in the Middle East. He's been speaking at an investment summit in Riyadh, for instance, overnight, but also talking about the relationship between Washington and Tehran and these efforts for Iran essentially not to have a nuclear weapon. So President Trump talking about that, saying he does not want Iran to have such a weapon, but he does want them to make a lot of money here. But he essentially, just to recap, doesn't want Iran to be a nuclear power, which, of course, is is what we've seen in the past. He is prepared to essentially exert maximum pressure and drive Iranian oil exports to zero if they don't.
All right, and more on that, of course, from this meeting that we're seeing between Beijing and Brazil. We are recapping some of these lines from Lula, the president, praising also Trump's approach to Israel's war in Gaza. That's one thing that just came through. But also talking about what the U.S. should have done, should have talked to China before these unilateral steps. They say more trade is good for everyone, and Brazil is not afraid of competing with the U.S. We got plenty more ahead. This is Bloomberg.
Chinese EV tech company Pony AI says it's targeting around 2028 to break even. That's after it announced deals with Uber and also WeChat. CFO Haojun Wang told us exclusively about their growth strategy in China and globally as they look to scale up robotaxi production.
You already see our deal with Uber. Actually, it underscores our strategy to scaling up. At the end of last year, we have about 250 robotaxis, primarily running in China, and our strategy is to scaling up. Just about 2 weeks ago, we debuted our 7th generation robotaxi in the Shanghai Auto Show, and we will deploy these robotaxis, new robotaxis, in China first, but also including the global market. So when we are exploring global market, definitely we're looking into the market where would have strong mobility demand, welcome regulation framework, and also strong partnership. So Uber will be one of our preferred partners to exploring these global markets. We are planning to launch a robotaxi with Uber in Middle East first in this year. So I would say definitely you will see more and more Pony robotaxis running in China and other global market in the coming quarters.
When it comes to business viability, when do you expect to break even or even turn profitable?
I think that's a very great question. And also that's why we're rolling out the 7th gen robotaxis, because these new robotaxis are so cost effective. We believe with these new robotaxis, we can prove, first of all, on the UE level, they will have a very good UE economics, break even making some profits. So once we have this proved, for sure we'll quickly scaling up with these new robotaxis. And with our larger fleet of our new robotaxis, that definitely will support the company to break even. So that's our path towards viability.
How quickly can you scale up when it comes to this WeChat deal? And is the goal for profitability still 2028, 2029? Do you have a date or a year in mind? Has that changed?
So I believe definitely the scale up will coming from like hundreds at the end of last year towards thousands and then tens of thousands. That's the path we'll take. For sure, this scaling up definitely will take a few years. So we do have, like James previously mentioned, probably like around 22 to 28. That's our target to break even for the company.
Leo, you mentioned, of course, the positive view of what can happen with your China business, but at the same time, because of increasing economic pressures in China, not to mention, of course, the growing competition as well. What are your prospects and the challenges that you could face headed towards that goal of profitability by 28 or 29?
Well, definitely there is up and down in China's economic, but as you can look in terms of a mobility service, China is still the biggest one. And also the demand in mobility service is still very, very strong. That's why we do see, in terms of the total addressable market, especially in China, that's still very, very huge. And for that huge market, for a company like Pony to make commercial viable, it only needs a small percentage in the mobility service, then we can still achieve that goal. And not to mention, we are also targeting at other global markets. So I think the room for us to grow and make commercial viable is very huge.
And that was Pony AI CFO Leo Haojun Wang there, speaking exclusively to Bloomberg's Sherry-An and Heidi Strout-Watts. Now, subscribers can watch us live and see our past interviews on our interactive TV function. That is TV Go. You can also dive into any of the securities or Bloomberg functions that we talk about and become part of the conversation. Send Bell and I any questions for our guests, for us. You just want to chat? Check it out at TV Go. Plenty more ahead. This is Bloomberg.
Out in the region, we have US dollar is the reference currency. So again, we are looking at both diversifying the currency, diversifying the asset classes into different asset classes like alternative or commodity. So gold is getting very popular.
Yeah, gold, China, even crypto. That was some of the things that we got from Amy Lo, where some of their investors and clients are really turning to now that we continue to see this sort of dollar selling wave that continues on here today. And certainly, it was a great conversation that we had in the New Voices event last night, Belle, where you and I were both speaking to the likes of UBS and Morgan Stanley and really talking about how this whole dollar de-dollarization trend is going to play out. And I think your guest had a little bit more of a nuanced kind of answer to that.
Well, I think there's also sort of Tina that comes into it. There is no alternative. Yeah. And I think that's also what investors find is, maybe there's sort of questions marks around the US exceptionalism story, whether that's going to be sustained. But at the same time, where else can you put your cash to work? But we're going to have more ahead. You're watching The China Show. This is Bloomberg.
Welcome back to The China Show. Here's a look at the HSI a half hour into the session. It looks like we are continuing to punch some gains here. We're more north of 1% in terms of this equity market. And certainly there has been a lot of optimism, whether it is what we saw in those U.S. CPI print, which did show maybe that tariff impact isn't quite there yet in the data. The Fed maybe have some patience there. And certainly when it comes to these earnings that we're getting through from the tech sector in Hong Kong and the China tech space, that is looking a little bit more favorable too. And maybe is why we're seeing these gains here this morning.
Yeah, that's right. I mean, take a look at some of those numbers. For instance, we had JD overnight. It rose on Wall Street. You're seeing, again, that sort of proportional gain on Hong Kong or in the Hong Kong listing this morning. JD Logistics a little bit under pressure, but tracking Tencent Music, for instance. Yeah. Tencent Music reports a day ahead of Tencent. That's the big one we're watching later today. Want to see how that gaming segment is going in particular. At Samsonite's actually a bit of a different story.
Yeah, I mean, the shares are plunging. This is after they missed estimates in the first quarter. And really, analysts are saying that they're not quite out of the woods yet when it comes to this tariff war. So they continue to face pressure here, and maybe the stock has not really priced in much of this de-escalation scenario just yet. So that's why we're seeing that down some 8%. But we mentioned Tencent is coming up next, Alibaba coming out later on this week as well. So there's still a lot on tap. I think we can push aside the tariff noise for a bit first.
Yeah, it's interesting. It's sort of like the trade war sort of faded back and earnings is really coming to the fore this morning. But take a look how we're going broadly in the session today. We're still positive, a little bit positive, but not really seeing the amount of gains that we saw on Wall Street or that level of optimism. I mean, US stocks have completely erased all their losses now from so-called Liberation Day. Watching Taiwan in particular, because you can see they're leading the gains this morning up 1.5%. Again, it tracks what we had on Wall Street overnight. Chip makers were really in the lead. Just seeing Nvidia, for instance, AMD cleared now to send billions of dollars worth of technology to the Middle East. So it's really this repealing that we're seeing of these Biden-era chip curbs. What exactly is the Trump administration going to be putting in place, though? The other big story, of course, as you said, Yvonne, really comes back to those US inflation numbers because it rose by less than forecast in April. And what's really coming across is that companies aren't really seeming to pass on the cost of those tariffs just yet to consumers.
For now, right? So certainly that gives the Fed a little bit more breathing room. And certainly you have the likes of Barclays saying, look, we just expect one rate cut now from the Fed, and it's pushed back to December. I think you're starting to see more of the banks push back their expectations of when the Fed can actually cut now, given that those trade tensions have softened a little bit. Certainly that's one to watch, but there you go, the CPI print there, holding pretty steady and really showing that a third straight month where we have seen prices actually not seeing that much pressure. So certainly that's one to watch here. But the pain trade still remains, right? Can you continue to chase this rally across risk assets, right? And certainly you heard from that Bank of America fund manager survey, and it was 38% of these fund managers are still underweight when it comes to U.S. stocks. That's the most in 2 years. Their exposure to the dollar, the lowest since 2016. Lots of questions to ask for Jack McIntyre, portfolio manager at Brandywine Global. And Jack, a lot of questions about whether this risk rally has any sort of legs. Can you continue to chase it?
So, Yvonne, we're probably in an environment where there's more questions than answers right now. That buy dip mentality that's been in place for for a few years now. You made a lot of money. We're seeing that unfold right now. Do you chase it? That's a tough one, because certainly given the developments, U.S.-China trade sort of relaxation, the odds of recession have been diminished, not totally eliminated. We've kind of moved beyond sort of, way beyond peak uncertainty with tariffs. But now we've got some other things kind of out there percolating on the fiscal side in the U.S. So I'm hesitant. My mindset is we've participated, we've had good returns. Let's kind of get a little bit closer to home, meaning become a little less convicted right now.
Yeah, I think, for instance, you've got someone like the Citadel founder, Ken Griffin, saying the best place to have been during this volatility would have been to have stayed in cash. And I think it's really exceptional that the VIX is back below 20 when you think it was above 50 just a couple of weeks ago. So how do you exactly invest in, and what's your strategy right now?
So, okay, a couple of things. So being global bond managers, we have the luxury of being able to move money all over the world right now. And, we've been, I'm going to say we're going to be at the forefront, because we were underweight U.S. dollars, and that was our highest conviction. Where we are now, though, we're still underweight, but we've been reducing that underweight. It's a crowded trade, as you just mentioned. We've got to see how other things sort of unfold. It's interesting. I mean, there's a lot of complacency around right now. You mentioned the VIX. Well, volatility in fixed income is still pretty low. I mean, we're starting to see that 10-year Treasury yield test 450. If we get above 450, we'll have to see what kind of response we get in some risk markets. Jack,
do you think that this dominance in U.S. financial markets, how much do you think is really seen to continue to erode? Is it just kind of at the margin? I mean, when you look at a Treasury market, do you think that they still continue to be a supplier of safe and risk-free investments in this world, or do you think that has shifted overall now?
So at the margins, I think it has shifted, and this is what determines prices, things that happen at the margins. I mean, the Treasury market is the deepest liquid market out there. I mean, it's not going away. It's still going to be the bulk of non-U.S. investors' assets. Same thing with the U.S. dollar, but it's not going to be as big as it was. There's this, the diversification. I don't think that's stopping. Central banks are profit motivated. So, and we've seen some good news, but part of that American exceptionalism wasn't just the tech sector. I mean, we kind of ballooned our budget deficit more so than a lot of other countries, and now we have to see how that sort of unfolds as we move down the path of kind of focusing now on the tax package. I mean, the tariffs, I'm not going to say it's old news. It's clearly not. It's still ongoing. But it's not it might not be the main narrative right now, at least for the next, I guess 90 days, since we're kind of on pause between the two largest economies, the U.S. and China. But next step up now is kind of does the Trump administration push the envelope, trying to do too much in the way of tax cuts, not enough government spending, and how that interplays with the consumption tax, which ultimately is tariffs. So there's a lot of things unfolding right now.
Yeah, let's get into that a little bit more. I love it how you say that maybe trade isn't going to be the main story right now. So what exactly comes to the fore for you? And you're mentioning sort of like how it interplays with the U.S. consumer. What are you seeing there as well?
Yes, Annabelle, it's interesting. In Trump 1.0, it was the tax cuts, the sequencing was different, the tax cuts and then tariffs. This time it was tariffs, and now we're going into tax cuts. So I'm really kind of focused on how this plays out. And we're going to know pretty soon in the House of Representatives, they in May, in this month, by Memorial Day, they should have an idea of what the tax package is that they can shift on to the Senate. So really kind of focused on that part right now, because again, on the tariff side, we're moving in the right direction. So yeah, and again, we are going to get tariffs. So this is 10% a minimum. It's going to influence the consumer, and part of this is how the ability of companies to pass on that tariff. Because if they can, you're going to see some maybe uptick in inflation, which we have not seen yet. But if they can't, maybe inflation remains fairly tame, but then it eats into their profit margins, and the equity market's not going to like that.
And what does it mean for this whole relationship between the dollar and rates as well? I mean, we've seen the breakdown between yields and the dollar of late. I'm just wondering, the bond vigilantes and arguably did box in Trump when it came to these tariffs on Liberation Day. Do you think that they could come back when it comes to the fiscal front?
Oh, very much so. The bond vigilantes have their finger on the trigger. And again, what's interesting is you kind of marry that idea with Treasury Secretary Bessent say, hey, we're focused on the 10-year Treasury yield. I mean, that's kind of seeming where the put option is. So we've got to see how that sort of plays out. I think what's been influencing currencies this year, more so than rate differentials, is growth differentials. I mean, that was kind of the roadmap we had, some version of sort of what happened in 2017 when the U.S. lagged the rest of the world from a growth standpoint. I still think that's going to play out. The Fed is, certainly we know that the Fed is not going to be cutting, at least what we know today, the Fed is not going to be cutting as much as what the markets had priced. And meanwhile, the ECB is continuing cutting. So that rate differential could provide a little bit of support for the U.S. dollar. But ultimately, I think the bigger determinant of currencies is going to be relative growth.
Yeah, and I can see, to your point, the Fed is really just in evaluation mode like a lot of other people. But just sum it up for us around the evaluation we have on the US exceptionalism story. Is that narrative still intact, or has it been permanently dented, do you think?
It's been permanently dented, but we're seeing sort of a mini reversal of it right now. Again, I mean, the Magnificent Seven, they took the brunt of the selling. There's some good, probably value anomalies, but this is not the start of a 3-5 year period of American exceptionalism. I think that ship has sailed, and I think ultimately the U.S. dollar is going to continue to weaken over the coming years.
All right. Yeah, certainly one to be watching very closely. That's Jack McIntyre, their portfolio manager at Brandywine Global. And still ahead on the China show, it's these deals that President Trump is looking to make around the world. And that includes, of course, the Middle East, where he's been in Riyadh, of course, speaking with the Saudi Crown Prince Mohammed bin Salman. We'll get more on that big investment pledges that has been made. More details ahead. This is Bloomberg.
Well, President Trump and Saudi Crown Prince Mohammed bin Salman have announced big investment pledges at their summit, although the exact value of the deals is not clear. For more, let's bring in our Bloomberg News editor, Jill Desis. But certainly there was a lot of optimism, as we heard in these press conferences, and it really seems a sea change in how U.S. policy is towards AI and the relationship in the Middle East.
Yes, well, Yvonne, I mean, first of all, we know that Trump essentially treats diplomacy as deal-making, or deal-making as diplomacy here, right? So, I mean, when he's going into the Middle East, a lot of his involvement in the region, I think he really wants to frame around, well, who can we really cut these deals with? So you had that, big sort of press showing between him and MBS where they talked about unveiling, I think they said $1 trillion worth of deals. I think plenty of reason to be skeptical about that figure. That is already kind of the value of, I think, Saudi Arabia's entire gross domestic product. We've seen, some other figures kind of floated around. White House says it's about $600 billion worth of deals. Some of the signage at the event suggested maybe $300 billion, but think the point here is just that, as you said, you really have Trump kind of coming into the region, not really talking about human rights or any other concerns whatsoever, giving this idea of, we'll kind of like let you alone and let you do what you want to do, but, we want to bring foreign direct investment into the United States. We had a pretty big defense contract deal announced, that Trump had mentioned, as well as, I think, really, to me, the big showing here, those, NVIDIA deals where you're talking about semiconductors that they're going to be giving to, Saudi-based companies. So I think all of that really kind of shows you that, yes, when it comes to Trump, it's all about let's make a deal, and then any kind of geopolitical relationships will kind of build off of that.
Yeah, so maybe a couple of question marks over sort of the numerical value of what that exactly ends up being. But you mentioned, of course, this deal that NVIDIA and AMD can send their chips to Saudi Arabia. So just dig into the details on that one.
Yeah, Belle. So essentially what we've heard now is that you've really got, again, NVIDIA and AMD giving these semiconductor chips to this company that is backed by, I think, the Saudi private wealth funds. So I think really raising some eyebrows there. To me, what's also really interesting is it sounds like there could be some additional details to come, some additional deals to come. A lot of questions about, I think, the sort of wisdom of NVIDIA sending really high-level chips to the Saudi government. I think there's raised some concerns about whether or not that could ultimately funnel its way to China, which obviously both the Trump and, previously the Biden administration have made a lot of noise about trying to prevent China from getting access to the most cutting-edge technologies. But it does, though, indicate, I think, this idea of this partnership of this idea that, Saudi Arabia, obviously, like everyone else in the world, wants access to incredibly high-end technology. The fact that you've got, I think, NVIDIA in particular being like a key player of this, and this, sort of announcement coming right as Trump is in region, I think is pretty momentous, and really, gives you an idea of the direction of, where, the U.S. is really kind of focusing its alliances right now.
All right, Jill. Thank you. Jill Dietz is there, our Bloomberg News editor. I want to check oil prices here. Obviously, we've been seeing some optimism, I think 4 days of gains when it comes to oil prices, just given the positivity when it comes to U.S.-China trade detente. You have President Trump's hostile rhetoric on Iran supply as well. Goldman had a very interesting take on this. It's not just about supply and demand, but you really got to look at the social media posts of the president now to determine where oil prices are going to go. So they've been scrutinizing Trump's social media posts, and they say Trump has been focused on oil and U.S. energy dominance, having posted nearly 900 times, and they think Trump favors about $40 to $50 for oil. Interesting take there.
Yeah, very interesting one. And of course, we've got OPEC Plus as well playing into this.
Yeah.
And Saudi Arabia really led them on sort of a simple mission, which was cut production, lift prices, cash in. But certainly we're watching how that cartel also sort of interacts, I guess, with that call. As you said, $40 to $50 a barrel. But the other world news that we're tracking, of course, this morning, still linked to what's ongoing in the Middle East, and President Trump saying that he's going to be looking at lifting U.S. sanctions against Syria. This is following the toppling of former President Bashar al-Assad. The move will provide a significant boost for Syria's new president, whose Islamist rebel group overthrew Assad's regime in December. Trump says his recent discussions with Saudi's Crown Prince and Turkey's president persuaded him to make the move. Israeli President, or Prime Minister rather, Benjamin Netanyahu says he's days away from ordering an all-out escalation of Israel's war against Hamas. Netanyahu says his armed forces are preparing to, quote, finish the job. That's after 19 months of attacks on Gaza. Hamas this week released the last surviving US-Israeli hostage, but still holds 58 Israelis, with fewer than half believed to be alive. We'll have plenty more ahead. This is Bloomberg.
The conversation about US exceptionalism and the challenge to US exceptionalism has very often been associated with the Magnificent Seven. And the Magnificent Seven, as much as that leadership in the US has been driven by the large cap or mega cap stocks, it's not synonymous with US exceptionalism. US is still the deepest and highest quality market. There are many areas within the US to traffic that are very interesting.
Well, that was Christina Au-Yeung there speaking at our New Voices event last night. And just for people that aren't familiar, and if you are interested actually in applying, because applications are open, but this is a Bloomberg program. It's intensive media training for senior women in finance. And we kicked it off last night with a really great event, really great conversations. You can see there from Morgan Stanley. But you were speaking as well with UBS.
I just love the fact that Christina Au-Yeung car drifts. Like,
she also does car drift.
That was my favorite thing.
Incredible hobby.
And how she adopts that sort of mentality to how she looks at investment. And I love it all. But yes, Amy Lo had a lot to say from UBS as well. This whole revival into China, that's certainly something that was echoed from Christina as well. And UBS Global Wealth Management has certainly been seeing this sort of pivot from their high net worth clients, increasingly shifting away from dollar assets and turning into likes of gold, crypto, and the mainland. Their Asia chairman, Amy Lo, told us why a diverse portfolio is key to navigating the risks.
I think one thing for sure is volatility is definitely here to stay, and uncertainty as well, despite the fact that actually, generally, the market reacted quite positively, and the temporary solution came a bit earlier than expected. And we've been talking a lot to clients lately, and so clearly clients are looking for diversification, looking for advice. I remember I just came back from a few business trips, and in some of the meetings, in one of the meetings, we have 12. The client bought, because 70% of our clients are entrepreneurs, so definitely it has a lot of impact to both their business and also to their investment. So in that particular meeting, he brought along the family office, the whole family office, the CFO, the strategy planning, and the question will be around, what should I do with my investment? How am I going to diversify my business? So I think clearly it has an impact.
You were in Taiwan, right, during that historic surge? What was it on the ground? What was it like among some of the clients that you talked to?
I was there when the NTD went up so much. And obviously, as I said, from the client point of view, they are also looking, because Taiwan primarily is a very export-led kind of economy, despite the fact that the tech sector is also quite strong. So we have a lot of discussion on how we going to help them and support them in diversifying their business. And there are also a lot of M&A opportunity. To be honest, right now we are very, very busy on all the corporate advisory activity. Okay, and that happened in some of the discussion in Taiwan, as well as looking at also diversifying their portfolio, because out in the region, we have US dollar is the reference currency. So again, we are looking at both diversifying the currency, diversifying the asset classes into different asset classes like alternative or commodity. So gold is getting very popular.
Okay.
And also looking at NTD, what are they going to do there? And then also looking at succession planning, and met a few of the next gen who are now in the picture running the family. So then the topic like setting up of the family office and also learning how to diversify is.
So is that the theme now, to diversify away from dollar and dollar-denominated assets? And where to?
I mean, into other asset classes like even crypto, gold, and also looking at other currency. Because as I said, bulk of our clients, almost 100%, if not 90, 100% are in dollar. So looking at also some other currency. And in the past, it's also quite US-centric.
Yeah. So
I've been also observing and and witness some of the diversification out of the US portfolio, 20-30% to Hong Kong, China. And I mean, you all know, in the last few years, it was a very difficult year and market in China, in Hong Kong. Whenever we talk about China, they almost want to shut me off. Don't talk about China. But now, in recent months, going into some of the international conferences, they will ask me proactively, Amy, what are some of the investment opportunity in China?
Yeah, great conversation between Yvonne and the UBS Global Wealth Management Asia Chairman Amy Lo there. But taking a look at some of the moves in the session so far today, Baidu is one that we're watching. There's actually just been an announcement or reporting rather from the Wall Street Journal in the past 30 minutes or so, but essentially that Baidu is preparing to test its driverless ride-hailing services for the first time in Europe. So it's going to be its latest efforts to expand overseas. Of course, it's really that rising competition we're seeing within the mainland market. China shipping stocks, port stocks also in focus, and this is really that de-escalating trade tension story. We're going to see a lot more exemptions on lots of different Chinese exports to the US, for instance, and again, these are the big beneficiaries.
Yeah, the shipping rates are going to shoot up. That's sort of the assumption here, just given this massive amount of front-loading that might happen during this 90-day cooling period between the US and China. So certainly we'll watch the shipping space very closely. We're also watching some of these Korea solar stocks as well. There's been a lot of talk about this space. There you go. We're up about close to 10%. So they're tracking some of these U.S. peers that we saw in the U.S. session on these earlier draft rules. Those seem to be favorable for the likes of the solar stocks like S Energy, that's up some 13% in Seoul right now. We got plenty more ahead, breaking down some of the tech earnings out of China coming up next. This is Bloomberg.
It's 11:29 a.m. in Tokyo. Japanese markets just about to go into their lunch break. Broadly in the session, you can see that we've got Asian equities that are still holding in positive territory, and that's probably actually really the China story. Japan, though, is under pressure today, and it's interesting because we were speaking with Jack McIntyre from Brandywine Global at the top of the hour, saying tariffs have sort of faded a little bit, but what's coming to the fore this morning in the sentiment is really earnings. And in Japan, we've had Nissan, we've had Honda, both of those stocks really under pressure so far today.
Yeah, I mean, and obviously the auto sector is very much engulfed in this whole tariff impact and this whole trade war,
I guess
right?
there's always a way to link back.
Yeah, so I mean, at least you got to look at what the commentary has been from some of these CEOs and what pressure they face moving forward. But certainly we're watching the tech sector in China because there's a lot of talk about what the earnings picture is going to look like. So far, it's been pretty favorable for the likes of JD.com, Tencent Music. Tencent set to report later on here today as well. We did speak to Mark Konyn from AIA Group earlier about what he's expecting for the earnings season.
We're onshore in China, so we're domestic, so we have to invest domestically. So it makes a lot of sense to hunt out opportunities where you're getting higher yield. We're seeing a lot of work done on cleaning up the supply chains and making sure they're robust given the trade tensions. And earnings outlook is reasonable. So in that environment, we see opportunities, tech sector in particular.
Yep, more on the earnings season now, and JD.com, we talked about the revenue growing at its fastest pace in 3 years after those stimulus measures from Beijing. And then Tencent reports today and projecting to sustain that steady pace of growth despite the domestic economic turbulence. So for more, bringing our team from Bloomberg Intelligence, senior analysts Catherine Lim and Robert Lee. Catherine, I'll start with you on JD. It looks like they're making some inroads in the food delivery sector. You have also these consumer subsidies really helping as well. What stood out to you?
Yeah, so JD.com is definitely benefiting from, the subsidies that we're seeing into electronics and home appliance. This is a key category for the platform. And then notwithstanding, they are now going into food delivery that is benefiting from, the additional spending on services within China. And really, I think this year, when we talk about consumption in China, it's within the country. Previously, a couple of years ago, it's talking about expatriation of Chinese consumerism. This year, we're talking about repatriation and everyone spending in China, which is good for platforms like JD.com. And the delivery, we've seen the government intervention overnight as been announced. So I think it's good for new players like JD.com, level playing field. We definitely can see more driving the revenues for JD.com in this space.
Yeah, talk us more in detail about that government regulator meeting and why exactly it needed to be called in the first place as well.
Yeah, so, it wasn't too long ago last month that, we saw on social media, they, being JD.com, Meituan, writing messages that seems to suggest that they are not really cordial. And, there were suggestions of exclusive agreements that is barring dining merchants from going into each other's platform. So that's not great. And, definitely the anti-monopoly watchdog, caught that and decided to actually have a talk with them. So all in late April, obviously, Ulama by Alibaba, they're not going to be sitting there and waiting for JD.com to take market share from their food delivery business. So, they've actually joined into the entire, I would say, chaos and party. And we start to actually see a 10 billion subsidy program coming from Ulama as well.
There's a lot of concerns about the cash burn for JD, how much they're spending on these discounts and cash coupons to get people onto the food delivery platform. How sustainable do you think that sort of strategy is going to be for JD?
Well, I guess overall, if you actually look at the e-commerce business, whether it's food delivery, whether it's just selling things on platform, it is a very cash-generative business. So every quarter, you're going to actually see that swings in the cash flow. For JD.com, relative to Alibaba, and I'm sure Rob can actually add on that, they're not quite into that whole big AI and cloud yet. That requires a lot of the cash and capital. More importantly, let us not forget that there is still the listed entity of JD Logistics and JD Property, I believe, or JD Industrials that's actually pending listing in Hong Kong.
Yeah, well, Robert, exactly. Let's go to you on that, because AI probably isn't going to be sort of one of the really standout areas to watch. It's more on that gaming side, right, still for Tencent later today?
Yes, I think realistically Tencent's business remains driven by games, driven by advertising, a little bit of fintech, and obviously underpinned by its position as the ubiquitous, a go-to app within China, WeChat. That's the reality of it. So I'm sure there will be a lot of talk about AI and the potential opportunities that it may bring in the long run, and also the scope to realise cost or efficiency savings in their business. But I think, we're unlikely to see any major surprises. It will be a relatively steady, solid set of numbers, but lacking surprise. Famous last words here. Not wanting to tempt fate. I think that's the nature of Tencent's business, isn't it? It's a very defensive play. They've got market leadership. It's quite a well-diversified business. It's not exposed to the intense consumer pressure that we see, obviously, in e-commerce or have seen in e-commerce. So, I think going into the numbers, they'll be solid, but, maybe not making such screaming headlines in the morning.
We could use a break from those. When you take a look at the external threats, though, I mean, with tariffs, how exposed is Tencent to U.S. tariffs?
OK, well, ultimately what they sell, or two things, really, it's service-based, isn't it? Computer games and obviously advertising and things that relate to their social media app. They're not selling physical goods, so therefore they've escaped the tariffs on that front, and their exposure to US tariffs is relatively limited. And the other thing is, most of the business is domestically focused, so again, it's outside the scope of US tariffs. So I think that's one reason why you've seen the stock price, outperform or perform relatively well compared to its peers. And, financially, it's a more defensive play. So I think we'll see with the, incumbent US president, because you never know what may be coming the next day. But, they're relatively well insulated from tariffs.
Yeah, and we had that, of course, that big embrace of China's tech scene as well earlier this year. But how does this all set us up then for going into the second half of the year, and what's going to be sort of the outlook, or what are you going to be watching for in the guidance?
OK, going back to the comments I said, quite a well-diversified defensive business. So I would imagine the outlook into the second quarter and even into the third quarter looks fairly solid. There's some seasonality in their video games business. Again, that looks good. However, I think there is some, risk. I don't want to overplay it or but in terms of the fourth quarter outlook, because ultimately they are dependent on sentiment holding up both in the corporate sector and in the consumer sector. Obviously, near term, I would guess a lot of people have said China's come out quite well from this tariff conflict, but that has led to, it has had an impact. The impact is not zero. The tariffs on China are higher today than they were, 6 months ago, and that is going to be a drag on economic growth. So I think there is a question mark as to whether that impacts sentiment and confidence in the consumer sector and in the corporate sector into the tail end of the year. And if that does come through, I don't think we're going to see a calamitous collapse at all in any of Tencent's business, but I think there is scope for maybe weakness on our advertising business, which is quite economically sensitive, and also their fintech business. Games as a whole is more slow and steady, you know, in times good or bad. You know, your hardcore gamers like David and, you know, is probably in his bedroom on his Xbox or whatever, so that's quite a defensive business, I would say. But anyway, I think, again, it's a defensive business. The chance of any major surprises either way is quite low. But, you know, we need to keep an eye on the economic barometers and certainly into the fourth quarter.
All right, David, gaming in his bedroom. Well, you can be as if you're not, Dave. Let us know if you're listening. But Robert, of course, very busy day ahead for you with Tencent numbers. That was Robert Lee there from Bloomberg Intelligence. And Catherine, it's not over yet because we've got Alibaba coming up later this week as well. But it really is, in the China tech scene, very much coming back to the DeepSeek effect. And really great story coming up because it's that sudden emergence of the Chinese AI play, of course, how that's also thriving despite the US efforts to slow it down. So more on this big take coming up. You're watching The China Show. Well, 6 months after DeepSeek really shocked the world and its founder, Liang Feng, becoming famous globally, insiders are sharing how the startup is thriving. And this comes, of course, despite Washington's efforts to slow down China's AI industry. Let's bring in our Asia Tech reporter, Jieping Wang, joining us. And Jieping, such a great story and so great that you're here to talk us through it. So, I mean, it's been a couple of months in the making. You've spoken to a lot of people around this ecosystem as well. But what did you learn exactly about DeepSeek and its founder as well?
Yeah, everyone wants to talk to Liang after the rollout of the R1 model. We tried, but it didn't work. He apparently only taking meeting with the top Chinese senior leaders. But for this story, we talked to over 24 former researchers and employees at DeepSeek, as well as VC investors and CEOs in China's AI industry in general. So DeepSeek is still a bit of a black box to us because we don't know its revenue or profit. But what we do find out is that this is a nerdy founder who really believes in the open source ethos, and he's probably spending much more time coding than he probably should, more time than his researchers, and he really empowers his employees, including interns, to take on big development tasks. So this is what China has in the startup spirit.
Yeah, I mean, it's so interesting just the amount of research you guys have done, the people you've talked to, and how the whole company works as well. But you mentioned where it's based, Hangzhou. It's a whole kind of place where a lot of AI sort of babies or little startups are coming through here. But tell us a little bit more about how the company works. What else have you learned from that?
Yeah, I actually traveled to Hangzhou for this story. We call the AI up and starters. We call it the AI 6 Little Dragons. So I didn't get to meet all of them, but I do noted from my reporting that investors, including some U.S. investors, are increasingly coming back to China, including Hangzhou, to look at potential investment opportunities. Like one of the little dragons is called BrainCore. It's usually compared to China's Neuralink. So it's apparently meeting investors for a new funding opportunity. So I guess the entrepreneurship and the VC world is starting to come back a little. Also, apart from the startups and upstarts, we also have the big guys, like we'll have Tencent and Alibaba earnings later this week. For Alibaba, it's also benefiting from the rise of DeepSeek. Like for its cloud segment, it's one of its fastest growing business, and Ali Cloud has been adding DeepSeek to its marketplace, and it's also betting those little dragons. So I would say there's a lot of comeback.
It's really interesting what you say about the mentality of the founder, and also the approach that he has with staff, and giving people a lot of free rein to explore new projects and take on ambitious goals. But out of the people that you spoke to, did anyone flag any risks? Because it can be a challenge to move from that sort of startup mode into more established business.
Yeah, chip is definitely one of the big hurdles because of the U.S. restrictions on China's ability to get the most advanced NVIDIA chips. But people also believe that restriction will also perhaps backfire in the sense that those Chinese chip startups are trying to really innovate. If they don't need to rely on NVIDIA. They have to ramp up their R&D a little bit. So this may be a double-edged sword.
Yep, but yes, it's great to highlight one of the tech rock stars out there and one of the emerging ones. Great piece there, Wang. Make sure to check out his big take here, the Asia Tech reporter joining us. And yes, it certainly was a team effort on that story. It's on the Bloomberg. It's on the for subscribers now. If you want to take a look on your terminal, just go to Function NI Big Take. You can also check out the big story there on Bloomberg.com. Now let's get back to where the whole U.S.-China discussion is right now. A former U.S. ambassador to China thinks the trade war between D.C. and Beijing is nowhere near coming to an end. Nicholas Burns told us the root cause of the current tensions lies in China's trade strategy.
Well, first of all, I start from a first principle, and that is that China's been the largest and most important disruptor in the global trade system for about 3 decades right now. There's a reason why the United States and many other countries around the world have placed tariffs on China. China's manufactured exports in particular is because China's been dumping them around the world below the cost of production. And it's been a killer for jobs, both in the United States historically in the last several decades, but also around the world. You have a situation now where Turkey and India and Brazil and Colombia and Mexico and Canada and the United States and the European Union have all put tariffs on China. So I have a degree of sympathy for the situation that President Trump and his team inherited, which was a situation that we left when I left in mid-January as ambassador to China. President Biden, a year ago, May 2024, placed 100% tariffs on Chinese EVs, 50% on semiconductors, 25% on lithium batteries. So the root of this problem is China and Chinese trade policy. The Chinese are trying to act now. You saw it in the statements over the weekend from Vice Premier He Lifeng, is that they're the innocent party, that they are the victim of this trade war by President Trump, when in fact, and that they're the responsible party, when in fact the reality is quite different. I think it's important to set the stage. Having said that, these are going to be very, very difficult negotiations.
During your tenure, you were trying to, if I may, rehabilitate a relationship that had worsened during the first Trump administration, develop conduits for communication, reestablish economic and security ties. When you left that post, could you have envisioned this turning out the way that it has, in terms of how the rhetoric has been ratcheted up, the tariffs have been put in place? Is it the worst case that you envisioned, or worse yet still?
I certainly did not anticipate 145% American tariffs on China or 125% Chinese tariffs on American goods. And the trade war that has resulted effectively led to a trade embargo as of the past week, when no ships were sailing with goods back and forth, when manufacturers couldn't export to each other's countries, and you see the significant shortage of goods that traditionally are important to both economies. I didn't expect that to happen at all. And that's the most important thing happening in the global economy right now, which is another reason I think that eventually both sides have to agree to a deal to calm global markets. We're the 2 largest global economies, so we have a profound impact on the health of the global economy, but we also need the global economy to be functioning in a rational and stable way. There's so much at stake. I didn't see that happening. I think few people saw that happening. You remember candidate Trump pledged 60% tariffs on Chinese goods, and people thought that would be a revolution. Well, 145 was a revolution of a different magnitude. And I think, we're not anywhere close to being out of the woods.
You're watching The China Show and taking a look at US futures. Look, I think this board really doesn't put it in perspective what happened overnight, because we actually saw the S&P 500 and the NASDAQ 100 turning higher for the year. So these risks around tariffs is certainly sort of fading into the rearview mirror for now, at least with this temporary truce between the US and China. It also plays into that question mark around US exceptionalism, and is that narrative still intact? And overnight, of course, we've been speaking about the new voices Voices event that we launched in Hong Kong, and speaking with Morgan Stanley about that, because the Asia Private Wealth Management business, the head of that, Christina Au-Yeung, talking about the trade truce rather between Beijing and Washington, how that set a scene or the scene for the rebound of stocks on Wall Street we saw, but also what it means for repositioning in China. Here, take a listen.
The conversation about US exceptionalism and the challenge to US exceptionalism has very often been associated with the Magnificent Seven. And the Magnificent Seven, as much as that leadership in the US has been driven by the large cap or mega cap stocks, it's not synonymous with US exceptionalism. US is still the deepest and highest quality market. There are many areas within the US to traffic that are very interesting. There is still significant innovation coming out of the US. And if anything, yes, we had experienced higher levels of valuations that were necessarily comfortable for clients to be getting into with fresh money. Now we've seen that retrace a little bit and actually setting a healthy scene to get back into some of these interesting names.
As it retraces, though, and maybe some funds flow away from the US, where do they go into? What are you advising clients?
So on the other side of the US is actually what we've seen now in China. We're seeing an emergence of really interesting themes coming back out in China. We're seeing that China is emerging from being the world's factory, from making and manufacturing products for everybody else and servicing everybody else, to actually becoming a global leading innovator in its own right. And opening and paving the way for repositioning in China. Valuations are not demanding. We've seen significant investment in R&D, talent, capabilities, their own supply chain, and we're actually very interested in and excited about the opportunity set in China.
What's the right proportion, though, to allocate to that market?
So in terms of global asset allocation, our investment committee is recommending something like a 40-40-15 split between fixed income, equities, and alternatives, with the balance in cash and cash equivalents. Now, rather than allocating to specific markets, it has become increasingly important to have a globally diversified portfolio to navigate through that volatility. This is why we have seen alternatives take up an increasingly important role, a core function in client portfolios. Now, a 40-40-15 model is designed to help an ultra-high net worth client with a balanced growth objective achieve something like a 7 to 8% total return over a 7 to 10 year horizon, but with about the same degree of volatility. Now, if I set the scene in terms of what that means, achieving 7 to 8% returns per annum with about the same volatility in an environment where volatility is elevated is significantly harder work than, say, in post-GFC era where volatility was much lower.
And that was Morgan Stanley Private Wealth Management Executive Christina Au-Yeung speaking at our New Voices event here in Hong Kong. All right, time now for trending in China, our daily look at what's making headlines in national newspapers. And we're talking about the Securities Times now, that they're saying there is still space for the renminbi to rise further against the dollar in the short term after China and the U.S. reached a truce on tariffs. A report from the China Center for Economic Research, meanwhile, at Peking University, also talking about the currency, saying the yuan is expected to remain volatile and rise this month, fluctuating between 7 to 7.3 against the dollar. But yeah, this appreciation of the renminbi is certainly one to watch. The fix today was quite interesting, right? It was strong, but not as strong as what analysts were expecting here. So perhaps some restraint from the PBOC here today, too.
Yeah, and actually, the first time we've seen the daily yuan support below estimates for 2025. So I mean, it's clearly something to be tracking very closely. But in terms of equities, we're actually seeing the Hang Seng pushing higher in the session today, up about 1%. So we're kind of off the highs of the day, but it's very much that earnings story that's playing into this as well. We had JD, for instance, on Wall Street, Tencent, Alibaba coming up to end the week. But that's it from the China show.